when you understand what's going on with the bond market and all the debt that's coming in the next 18 months. I think it's going to be 4 trillion. And like Clive said, there's no limit anymore to the debt ceiling. June 1st, 2023, Maneco 64, home of alternative economics and contrarian views. We're going to look at the bond market bubble. Yes, in my opinion, that's burst. But I warned about it back in 2020, August of 2020. I warned about it back in 2019. And it's the most important market out there because it sets the price of credit. It sets interest rates. It sets, of course, the price of borrowing for everyone, not just the government. And I think things are precariously dangerous for the whole system. It's not just the banks that are in trouble, and we're going to look at that today. Before we go into the bond market, though, just wanted to talk a little bit about the U.S. debt ceiling. The House has voted it through. I was going to have Clive on today to talk about it and also the bond market. But unfortunately for us, and fortunate for him, he has an appointment with his bullion dealer. The bullion dealer has quite a bit of silver maple leafs for sale, so he wants to go there and negotiate. So that's good for Clive. But he sent me something about the debt ceiling deal, and he told me to read it to you guys. So here it is. This is what Clive said. By the way, the U.S. debt ceiling agreement, which has been approved by the House of Representatives, looks to me like a complete cave-in by the Republicans to the demands of the Democrats. Amazingly, there is no debt ceiling for the next 18 months. It's a free-for-all. Yellen can fill her boots. Whilst the Republicans are trying to make it sound like it's a good deal because they got their way, they couldn't be further from the truth. Meanwhile, the Democrats are struggling to hide their glee at what is a very bad deal for America. Almost all of the Republicans' proposed spending cuts have been thrown out of the window or severely pared back. So there you go. So this is also interesting because we're going to talk about bonds and what this means by Yellen filling her boots. It means that she's going to keep borrowing more. The Treasury going to keep issuing more and more bonds. And of course, interest rates and yields are going to keep going higher, in my opinion. That is, of course, if the Fed and Mr. Powell don't resume QE, don't stop QT, and start buying bonds. That's my opinion. For those of you out there who think bonds are going to go back to zero, the yields, I think you're dreaming. Unless, of course, they do massive QE, they do another 10 trillion. But the flip side of that, of course, will be a currency that buys very little, a worthless currency. So yeah, the 10-year yield can be at 3%. But it doesn't mean anything because I would say gold and silver will be multiples of where they're now. So back to the bond market bubble, and it's all related to this. And I remember I warned back in 2018, 2019, 2020, and there are many people out there who said that because of demographics, that yields would never rise much more than 2%. And I said, that's rubbish because the reason yields have gone down is because the central banks have been buying government bonds through their QE. The Fed's balance sheet went from below $1 trillion in 2008 to almost 10 trillion back in 2020. So what that did as well to not just speculators, but fund managers, insurance companies, pension fund managers, they had to try to front run the Fed, the Bank of England, the ECB, and they bought these government bonds. They were told by the regulators that they needed to keep government bonds because they were safe. They were like, gilt-edged, right? They were risk-free investments. But in 2020, in August, I made a video, and I'm going to put it up in the cards, and I warned about the bond market bubble. And at the time, I think there were $9 trillion in bonds, $9 trillion in bonds that were negative, had a negative yield, which is crazy, of course. But that happened because of central banks, not because of demographics. And even before that, in 2019, the top of the bubble was 17 trillion in negative yielding bonds, not just government bonds, but also maybe some corporate bonds. And many of you know, of course, that I worked in the bond market. That was my specialty when I worked in finance. I started out at a small private bank in Switzerland. My bosses were bond guys. They used to be bond dealers in their prior career before starting their own business. And in London, I worked as a bond broker, a futures and options broker, all in the bond markets. And I'm very familiar with bonds. And when I saw negative yields, rates staying at zero and stuff, that was like a red flag to me, because I started out in the late 80s and up until the early 2000s, and even up to 2007 and 8, normal bond yields were more like 4, 5 to 6, 7, not 0 to 2 or even negative. So I knew we were in a massive bubble, and the excuse about demographics and deflation now I think have been proven complete and utter fallacies, I would say. So what I'm trying to say here is that the bond market bubble is it's the biggest bubble of them all, and I said that in 2020. And why is that? Well, because all financial assets are priced off bond yields, and bonds, of course, are the price of credit. And they're all different kinds of bonds. They're government bonds, corporate bonds, they're bonds for international organizations, municipal bonds, mortgage bonds. But the government bonds are supposed to be the safest. But unfortunately, central banks made it the least safe. They made it really risky. And I think it's not just going to be banks that are going to be in trouble. We saw already last year that the defined benefit private pensions in the UK, they were collapsing. I think there's going to be a lot more collapses. I think a lot of the company pensions, public sector pensions, they're all going to go down the drain. And the only way to save it, of course, would be massive QE, but that would destroy the currency. So I think things don't look good. How long is this going to take? I don't know. Back in 2020, yields are still really low, and I was warning it, and I said, I don't know how long they can keep it going. Well, they kept it going for another 18 months, so they could keep this going for another 18 months, but I think it's going to end in tears. And I'm going to give you an analogy of the bond market, which will help explain why it's so dangerous and why things are getting really precarious for the bond markets. And one of the reasons I'm talking about this is because Clive also sent me this picture here of the United Kingdom 50-year government bonds. So this is the 50-year gilt. So you can see it traded as much as 210. And yes, 50 years is a long one. It has a long term it has a long duration, so it is riskier because then there's more volatility in it, because a lot can happen in 50 years. But be as it may, this bond went to 210 back in 2019, 2020. That was when there was massive QE. So I explained in the video from 2020, because a lot of people back then were saying, why would people buy bonds with a negative yield? Well, because if the yield dropped, let's say from -0.1 to -0.2, If you had a 50-year government bond, as you can see here, the price would have gone from 150 to 200. So you would have made money just like holding a tech stock. So it became a bubble, as I said. But normally bonds mature, in 50 years, let's say this one, and you get 100 pounds back. But as you can see, this has dropped from 210 to 36. So can you imagine what this is doing to pension funds, government pensions, public sector pensions, hedge funds, private equities, loans? I mean, this is just a total disaster. And this is, so they were holding a tech stock as safety. And I say tech stock, of course, it's not a tech stock, but it is acting like one. And the reason why this is happening, especially to the long-term bonds, is something called duration and convexity. And you can look this up. It's very technical. People in the bond market know about this, but it's just the sensitivity of the bond price to interest rates and how long the duration of the bond is. So the analogy is this, let's say a 1-year gilt. If you're at a amusement park, you're in a roller coaster, you're still down here and it's all flat, it's boring. That's the 1-year gilt. But the 50-year gilt yield is very fun when yields are going down in negative, because you go all the way up, but then when it turns, you crash. And I'm afraid this is, this roller coaster could break, and it could wreak havoc on everything. Of course, there's always the central bankers and the governments out there. They might try to intervene by more QE, more excuses, and try to drag everything on and on. And that, of course, will only hurt the currency, as I've said. And that's why I keep going on about having hard assets. And if you want to have liquid hard assets, of course, that are money, it's gold and silver.
With rising inflation, bank failures, and massive layoffs across multiple sectors, the future of the economy remains uncertain. It's no wonder the central banks have been getting prepared by stockpiling gold. At ITM Trading, we have spent over 27 years building a team of seasoned researchers and analysts who can help you prepare for any financial crisis. Our experts are ready to provide you with proven strategies to safeguard your wealth and assets in the event of an economic downturn or currency reset, which is frankly inevitable. Don't wait until it's too late. Schedule your free gold and silver strategy call by clicking on the link in the description below.
So there are still a lot of those out there who were wrong 2, 3, 4 years ago about the bond market. They're coming out again and saying that yields are going to go back to zero or even negative. But I don't believe they will. Of course, the central banks can print, the Fed can actually add 20 trillion to its balance sheet, and it might do that. But then you'll see gold and silver at multiples of where we are, because gold and silver reflect real value, and the bond market will become even more of a bubble. So with that, let's quickly look at where the markets are this morning. It's 8:34 a.m. London time. We've got spot gold at 1955. That's down about $7. High's been 1967. We're right near the lows here. Silver is down 18 cents at 23.31, down 0.75%. And I think we should go past worrying about these prices. We should be thankful that we can still exchange relatively small amount of these rapidly depreciating fiat currencies into a good amount of gold and silver, actually, to be honest, for the next 18 months. It's crazy. The stock market is virtually unchanged, so I won't go through that. The futures, the indices, the pound is down 0.2%, 124.18. The euro is down 0.2 as well, 106.70. The dollar is up a third versus the yen. It's almost at 140. Dollar's still fairly strong against the yuan at 713. To the other currencies, Aussie dollar is down 0.2 at 64.88. The dollar is unchanged versus the Canadian dollar, 135.82. And the Kiwi dollar is down 0.5% at 59.93. To the commodities, WTI crude is up 0.33% at 68.35. Brent is up a third at 72.84. Platinum is up $7, is trading just above $1,000. So platinum has corrected as well a bit in the last few weeks. And high grade copper is up 1 2/3% at 370. Quickly look at the gilt market. The 2-year gilt yield is up 5 basis points. It's trading around 440. It has come off a little bit from the beginning of the week. The 10 years at 423 and the 30 years at 456. That's up 5. The 50-year is up 4 basis points at 419. I expect these yields to go up even more unless, of course, we see QE from the central banks. In the US, the two-year yield is at 446. That's up 8 basis points. And the 10-year is up 5 at 368. So there you go. With that, I'm going to wish you all a very good day. Take care. Bye.